After a ton of strength, just a little bit of weakness creeping into this equity market. Live from New York City this morning. Good morning, good morning. Equity futures down by 0.4% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the team at Apollo say the Fed put is back as Alarian thinks Powell risks losing control and the recent equity market rally meets gravity. We begin with the big issue. Too far, too fast.
Things are going a little bit too far.
A little too fast.
This market is priced for perfection.
It is beyond perfection at this point.
The markets have really pushed the envelope here to such an extreme.
We've had the great rally.
Big rally last month.
We are very much ahead of ourselves here.
Too far ahead of the Fed.
The market is misinterpreting some kind of enormous Fed pivot.
Markets have now priced in over 4 rate cuts next year.
To have so much in the way of rate cuts at this point, with a soft landing, it is really quite curious.
The market is discounting, a Fed that can land this thing perfectly without any hiccups.
Every hard landing starts looking like a soft landing first.
The headwinds for the economy next year are woefully underpriced into market sentiment right now.
This everything rally remains challenged.
By the end of December, first weeks in January, that's when we get that uh-oh moment and that we went too far.
Stocks meet gravity. Let's have that conversation right now. Morgan Stanley's Andrew Slim and Cameron Dawson and New Edge Wealth. Cameron, first to you. Have we moved too far, too fast?
Well, clearly equity markets are overbought here. We have seen that movement up in November, which resulted in things like the RSI having an overbought reading. That suggests that you could have some digestion. You also have the inverse of that, of a lot of yields being oversold and finding a little bit of footing. The question is, once you have the digestion, where do you go from there? And the thing that we're asking mostly on the yield side is, what kind of data would really justify this 120 basis points of cuts being already priced in? And how much more weakening in the data would you need to see yields move even lower from here? Which just raises the point that maybe yields are upwardly biased if that data doesn't come in and justify what the bond market already has priced in.
Andrew, on the equity side, you were long stocks, you stuck with it, it's delivered big time. You said stick with mega cap tech, it delivered big time. Year to date, up a ton. What's the trade now for you, Andrew?
Well, look, my call this year, as you know, Jonathan, has been to be overweight growth and value and be underweight the defensive stocks. In the last couple of weeks, they've done very well at the expense of the mega cap 7. So I can't believe I'm saying it, but I think there is another opportunity by these very, very large companies that largely have produced stellar results, and they have huge stock buybacks coming next year.
Cameron, outside of that, we've seen these subtle leadership shifts more recently. Is that a taste of things to come, or are you on the same page as Andrew?
Yeah, rotation seems to be the name of the game. And we are asking the question of all this rotation that you've seen just in the past couple of weeks. Maybe that is the harbinger of what we have in 2024, which just means that those areas that have been left behind, that are trading, even some parts of the market trading near their 2020 COVID lows, if that's a setup for a big rotation and a relief rally in those areas. But I think the point is really good that there's still a lot of fundamental strength in the leadership names that have led the market this year, which just means that they've earned their leadership. We've seen huge earnings growth, 180% earnings growth if you look at the Magnificent Seven on average. The challenge next year, though, is that decelerates to 26%. That's still a lot better than the market, but that second derivative deceleration will be really interesting if we think about if they can maintain that same degree of leadership.
Stocks down a little bit this morning. We're down a third of 1% on the S&P. On the Nasdaq, we're down by 0.4%. Mike McKee, tons of economic data through this week, climaxing with payrolls this Friday.
Absolutely. You were over at Apollo this morning. They gave you breakfast, right? And it was probably very good. Did you take more than you thought you wanted because it looked so good? That seems to be what's happening in the markets these days, is people are getting a little carried away with the narrative that the Fed is going to have to raise rates or lower rates depending on which way you're looking at it. They want to keep things steady, and the data this week are expected to make that case. We get S&P PMIs coming up in this hour. We'll have those for you. ISM services, JOLTS, ADP employment, jobless and continuing claims, November jobs, and that Michigan sentiment number where we watch what they say about inflation. And all of them expected to continue the narrative that the Fed has been following, that the economy is gradually weakening and a soft landing is possible. So if you're going to get a market reaction, it would be in the surprise. The services index are expected to show little change and prices falling. Jobs measures, the labor market is loosening and wage growth slowing. That's what we're likely to see on Friday. And then the sentiment index, little change with the inflation concerns easing. If we don't get any of those, then you could have a reaction in the markets. And then the narrative becomes this, that financial conditions are easing so much because we've seen rates go down in the markets and the pricing in of Fed cuts. Well, here are three different financial conditions indexes telling almost three different stories. The white line is the Federal Reserves, the blue line, the Chicago Fed, and the gold line is Goldman Sachs. Now, each one of these is different time frames as well, monthly, weekly, and quarterly. And the weekly and daily numbers show that there's not as much easing as anticipated. So what's really happening out there? The Fed is likely to look past what's happening in the markets now, figuring they'll change their minds sometime soon, and they'll stay the course.
Mike McKee, thank you. Just for the record, I skipped breakfast, but I did hear from TK. He's never leaving. He's moving in to Apollo Global Management here in New York City. Mike McKee, thank you. Andrew Sliman, I want to come to you on what Apollo said earlier this morning. Jim Zauter, Torsten Slog, saying the Fed put is back. Andrew Sliman, is the Fed put back?
I think for now, the data coming out, particularly next week, the inflation numbers will support that the Fed can back off. My biggest concern is next spring when the CPI numbers year over year are going to get tougher for inflation to show continued improvement. And then the question is, what will the Fed do at that juncture when it's going into election? That I don't know. But for now, I'm not worried about or need a Fed put. I think the inflation numbers are going to support. And that's why I think we could get another rally next week in the market surrounding the inflation numbers into year end. We'll have to see next year. That's the question of a Fed put. It comes later next year.
Cameron Dawson, what's your take on that?
I think the Fed put is always there. It's just a question of what is the strike price, meaning under what conditions is the Fed ready, willing, and able to step in and support markets. And because inflation has remained elevated, though it is decelerating and is above its target, we thought that that strike price is effectively lower. A good reminder of that is that earlier this year, we had some of the biggest bank failures in history, and yet the Fed continued to tighten policy afterwards. In prior times and prior cycles, the Fed would have been probably far more eager to ease policy. So yes, inflation coming down does increase their degrees of freedom. It makes it so that they're more able to tweak policy lower. But to truly deliver 120 basis points of easing without economic weakness and just inflation remaining somewhat above trend would suggest that that might be too aggressive.
Cameron, I'm with you. Andrew, not all rate cuts are created equally. If this Fed starts cutting because inflation is coming down but growth is still okay, I get it. Constructive view on the equity market kind of stacks up. But Andrew, what if growth starts to disappoint? This is something I know you're focused on. If we start to get bad data and the bond market carries on rallying, would you expect a split to develop between stocks and bonds?
Yeah, to me, that's the biggest worry, Jonathan, is if discussions of Fed cut because the economy is slowing, then we're not going to make $245, $247 of earnings next year, which is consensus right now. And that challenges the thesis. So in my opinion, it's really about the bond market. Watch financial conditions, watch credit spreads. If they remain tight, it's a sign the Fed can cut because inflation is coming down. If they widen out, there's a sign of more stress. And then actually, I think the market will rotate into the more defensive stocks that have really been the underperformers this year. That's what I'm watching. I don't expect that. So I think it's a combination of value and growth stocks next year yet again. But that is the biggest risk for next year.
Let's just build on that a little bit more, Andrew. How big is the disconnect right now between what the equity market is expecting in earnings and what the bond market is expecting from the Federal Reserve in cuts?
Well, yeah, look, I think that if you look back to all the bears on Wall Street at the beginning of the year, what they got wrong was earnings. Earnings are going to come in 220 this year. Most of the bears were predicting 170 and 180. So I don't put a lot of credence in Wall Street's ability to predict earnings. It's not historically been particularly good. I listen to companies, and I hear right now, I don't see a big earnings downgrade for what they see. But that's, they're looking at the next couple of quarters. And so if there was a slowdown in the business, I think it would come from the companies that we're talking to. But right now, I don't hear it. So I'm going to start the year with consensus right around 245, 247.
Cameron, just to build on that as well, do you think right now, looking at consensus expectations for profits, are they too great, or expectations for rate cuts, are they too large?
Yeah, I mean, if you look at underneath the surface in the profit expectations, what's in there and it's really interesting is an actual acceleration in revenue growth. And that is in contrast to the deceleration expected for nominal GDP, which just suggests that there is that disconnect where the economy is expected to slow, yet revenues are expected to go up at the same time that margins are expected to go to a new all-time high. I would say that the equity market is not pricing in any form of recession. 12% growth next year, another 10% growth in 2025. And that is where the disconnect is with the bond market, which if you're going to go over 75 basis points of cuts, you're effectively saying that there's a higher risk of recession. So it's a question of, does the equity market come down to the bond market, or the bond market then come up to the equity market?
A lot of this needs to be reconciled. Andrew Sliman, I know you've got to go. It's great to catch up with you, buddy, as always. Cameron Dawson is going to stick with us. We'll get you an outlook for 2024 from Whaley of BlackRock in just a moment. Equity futures pulling back 1/3% on the S&P. Let's get you some movers. Here's Abby.
Ahead of taking a look at what is dragging on markets this morning, John, let's take a look at one leader. That is CVS. Shares are popping higher after the pharmaceutical healthcare company reiterated their 2023 guidance, offered 2024 guidance that apparently investors like. They also increased their quarterly dividend by nearly 10%. They're launching a new drug reimbursement system to simplify how they get paid. It could be industry changing. Investors liking all of it on a stock that's down 26% into today. Take-Two Interactive down 3.5%. The trailer for one of their popular Grand Theft Auto, the next version, 6 specifically, is positive, but it won't be out until 2025. They haven't given an exact release date, and some analysts are saying that could be a worry. And then finally, Coinbase down 1.3% as Bitcoin comes back to earth just a little bit. Well, it's bringing the crypto space with it, John.
Abby, thank you. More from Abigail around the opening bell about 18 minutes away. Equity futures down by 0.4% on the S&P. Coming up, gearing up for the year ahead.
It's going to take time before we get inflation under control. And I think that process, meaning into next year, still means that the downside risks to the outlook continues.
That's the view from Apollo. Coming up next, the view from BlackRock, their global outlook for 2024. An exclusive conversation with Chief Investment Strategist Whaley up next.
It's going to take time before we get inflation under control. And I think that process, meaning into next year, still means that the downside risks to the outlook continues. Risk is if people wake up suddenly in the next few quarters and say, wow, maybe there's more downside risk to consumption, because the hit is not only from interest rates going up. If people also start losing their jobs and the labor market soften, which is what the Fed has been talking about, we get the double whammy of both high interest rates hanging in there at the same time while the labor market finally softens.
That was Apollo's Torsten Slog weighing in on the impact of higher for longer. BlackRock out with its 2024 outlook, recommending investors seize opportunities within the changing environment. Here's the quote from them. The new regime of greater macro and market volatility has resulted in a dispersion of returns. We believe an active approach to managing portfolios will carry greater rewards. A sea change from the one-and-done asset allocations that worked so well during the Great Moderation. That period is over, and it's time to seize opportunities the new regime has to offer. BlackRock's Wei Li joins us right now. Wei, let's talk about that new regime, that title, grabbing the wheel. Wei Li, what's changed?
Well, as we look ahead to 2024, as we think about outlook, context is everything. So earlier on, I heard multiple references to lending. And if you look at the economic activities more recently, compared to a normal expansion, it feels like a strong expansion. But if we zoom out, actually, we're still at pre-pandemic levels. So nothing is flying. There is no landing. We're just climbing out of a hole. And ultimately, what this means is that we don't need a recession as a result of that. But the bigger point is really that we're now in a different macro environment, an environment where we do want to put money to work. And it's even more important to do that. But the reward for being active is greater, for being selective is greater, which is how we're thinking about implementing the themes for 2024.
A part of your approach is to harness mega forces. There's 5 of them, 5 themes, I believe. One is AI. Of those forces, Wei Li, do you think the focus is going to be on things here in the United States? Does that dominance around that tech story continue?
We currently still have a overweight in the DM tech and AI megaforce, which has been a long-held overweight in our portfolio. As we think about opportunities in this particular megaforce, we have to think about the multiple stacks where AI can have an impact. You start from the semis and the chips to the foundational model, the data center infrastructure, as well as all the way to the third kind of stack around applications. So far, if we look at the performance of the Magnificent Seven, they almost doubled. So clearly, this theme has already played out very well. But we see future further stacks providing greater runway for this theme, which is why we're still overweight in this exposure. And earnings are coming through. And looking ahead to 2024, tech is expected to carry more than 50% of the earnings growth for next year. So certainly, this is different from the dot-com bubble. We do think that there is more runway, which is why we're still overweight. And as we think about the broader U.S. equity allocation, whilst we have a underweight to the overall benchmark, the overweight in AI and tech actually takes us close to a neutral allocation. And on top of that, you consider the greater alpha opportunities, selective opportunities in this environment versus the period after global financial crisis where central banks were taking out a lot of macro uncertainty with their forward guidance. Now, the room for having differentiated view, the reward for that is greater and the room for that is greater. So we certainly want to think about being more deliberate and selective as we think about investing in 2024.
Wei, you alluded to it just then. You're not exactly bulled up aggressively on U.S. equity markets. Just geographically, is it time to look outside of America after a period again of absolute dominance and exceptionalism?
Well, with the overall close to neutral allocation to U.S. equity market, including the AI allocation and potential alpha selectivity opportunity, we also see opportunities outside of the U.S. exactly as you say. So if you think about Japan, for example, which is a country that we have liked for most part of this year, we upgraded twice through the course of 2023, but we think that this has more room to run, but we like it on a currency unhedged basis as we think about the prospect of exiting from yield curve control. We also like, well, emerging market is interesting, and increasingly we get questions around emerging market ex-China. So here we look at countries like Mexico, countries like India that are actually benefiting from the cross currents of some of the mega forces that we have identified, including aging population. They have younger population, including digitalization trend. But of course, in these markets, valuation has run up. So we even want to be more selective within these exposures as well. But certainly, we want to think about pushing against the home bias tendency as we think about geopolitical, geographical as well, diversification for 2024.
Wei Li, appreciate the update. Thanks for jumping in front of a camera to give us your outlook for 2024. Wei Li of BlackRock. Cameron Dawson and New Edge, just waiting patiently, listening to that. Cameron Dawson, that final line there, time to move away from the United States and look elsewhere and drop the home bias. What do you make of that?
Yeah, I mean, the allure of international markets has been persistent for years because they've traded at such a huge discount to the US, as well as underperforming so much on a historical basis. The challenge is that these markets have been value traps. They've been underperforming for nearly 15 years. The question is, what is the driver to get that underperformance to end? When we look back in history, the only time you have sustained major bull markets in international versus the US is when you've had major dollar bear markets, which just means that a dollar call is absolutely critical to going overweight international markets. We are finding lots of opportunities, though, within international markets. Our international portfolio trades at half the multiple of the S&P 500, which just means that there are pockets for good quality names, but it's hyper selective in those markets because they remain in very distinct downtrends versus the U.S.
Cameron, BlackRock neutral U.S. equities, but within that neutral is a big overweight to that big theme, AI and big tech. Would you push against the leadership of big tech this year for next year in 2024?
I do wonder if, just as obvious as being underweight big tech was at the beginning of 2023 because of rising real interest rates, and of course we now know how that worked out as big tech was a big leader despite rising real interest rates, that the obviousness of crowding into big tech into 2024 could create the inverse scenario, which just means that if we look at positioning in tech, it's become very crowded. Sentiment is quite ebullient, and we know that you've had a big uptick in expectations. These are still very great companies. It's just a much higher bar to jump over now that you have seen so much crowding into that space. So we still have an overweight to tech, but we're trying to be very careful and cautious with the idea that if you have already seen everybody get there effectively, does that just create too high of a bar to jump over, despite how good and great these companies are in a short-term period?
And just look at Meta and Nvidia here today, absolutely flying, huge repricing there. Cameron, good to catch up as always. Cameron Dawson there of New Edge. Your equity market at the moment, 7 minutes away from the opening bow, something like that. Equity futures negative by 0.4% on the S&P. Coming up the morning calls and later, JP Morgan's Jack Manley warning investors to contain their enthusiasm or risk getting burned. That conversation up shortly. Four or 5 minutes away from the opening bell, just adding to yesterday's losses, just a touch on the S&P, down by about 0.4%. That's the price action. Let's get you some morning calls. Your first one from Bank of America, downgrading UBS to neutral, seeing a challenging year due to mounting expenses. Your second call from Raymond James, downgrading Lulu to outperform, saying recent channel checks point to slowing growth in the fourth quarter. And finally, UBS downgrading United Rentals to neutral, expecting limited upside given the weakening macroeconomic landscape. That stock is down by almost 3%. Coming up, JP Morgan's Jack Manley making a case for bonds over stocks. That conversation just around the corner. Equity futures negative this morning. Your opening bell just around the corner. 25 seconds away from the opening bow this morning. Good morning. Pulling back again, just a touch on the S&P. Yesterday, biggest one-day loss, biggest one-day drop in about a month on the S&P 500, taking some more weight off that rally in the previous month, just a little bit. We're down 1/3 on the S&P, down 0.5 on the Nasdaq 100. There's your opening bow. Switch on the board and get to the bond market yields. Back-to-back days of double-digit basis point moves on a 2-year. On what? Chairman Powell tried to push back a little bit on Friday, got rolled over, steamrolled in Friday's session. Monday on nothing. Yields up big time across the board this morning, down 4 on a 10-year, 4.2145. In the FX market, the euro showing some more weakness against the dollar, just about holding on to 108. 108.18 on that currency pair, negative by 0.2%. And crude, 73.40. We're up by about 40 cents, up by 0.5% this morning. About 30 seconds into the session, more losses for you, down about 1/3 of 1%. No drama here on the Nasdaq with negative 0.4. One stock to watch at the open, AutoZone, the auto retailer, reporting results that beat expectations. Abby has this one. Hey, Abby.
Hey, John. And investors are trying to figure this one out because the stock had been up as much as 1% just moments ago, now up about 0.3%. They did beat earnings. Same-store sales also showed growth of 3.4%. So investors basically cheering it, but revenue's flat, so that could be holding them back. But let's not just stop at AutoZone, because we also have company news on CVS. They did reiterate their 2023 guidance. They offered 2024 guidance that investors apparently like. They raised the dividend by about 10%. And they also are changing how they get reimbursed for prescription drugs to simplify the system. Some experts are saying this could change the system for everybody. As for consumers, it's a mixed bag. Some drugs will be a higher price, some will be lower. CVS saying more will be lower. And then finally, sticking with healthcare, J.M. Smucker, kind of healthcare, they are saying that the weight loss drugs not affecting their results in a material way right now, apparently not affecting jelly demand. They did beat earnings by 5.7%. They cut the fiscal adjusted earnings just a little bit, but perhaps on the sales, profit, and volume beat, that stock is up 3.3%.
Good for the soul. Healthcare. Abby, thank you. J.M. Smucker up by 3.3%. Let's turn to the autos. Check out Tesla. Struggling as strikes spread to Denmark. NIO moving higher as profitability tops estimates thanks to cost control measures. Ed across both stories this morning. Morning, Ed.
Good morning, Jonathan. Tesla basically flat as we're talking now, a little higher up, 0.4%. If it did fall today, it would be the 5th straight day of declines, which is the longest streak of declines since August. The story is a Danish union acting in solidarity with its Swedish counterparts. And the impact to Tesla is that the Danish union workers on docks are not loading vehicles or transporting them through to Sweden. Sweden is Tesla's 5th biggest market in Europe, not 5th biggest overall, but 5th biggest in Europe. And as you know, Tesla has been holding out on signing a collective bargaining agreement with the unions in Sweden, collective bargaining a standard practice in that market. Elon Musk has called the Swedish union's approach insane. And as you know, Tesla has pushed back against union efforts in various markets. The story with NIO is they were down in pre-market. They gave a forecast for the current period where EV deliveries will come in pretty significantly below expectations and revenue will miss. But it's turned a corner. We're now higher 6% on the ADRs for NIO. The loss that NIO experienced, 4.6 billion yuan, which is $644 million US dollars, narrower than expected. This is a company that has had recent job cuts, trying to rein in its spend. Like many before it, its ramp is proving costly in its pursuit of profit to bring EVs to new markets, not in America, but places like Europe and the Middle East.
Ed, before you go, just on Tesla, we're talking about Sweden. Let's talk about the union effort here in America. Just how big is that for Tesla at the moment? Is it growing?
Yes, it is. It is growing in sentiment, but Tesla has always pushed back and said, well, frankly, we're able to pay better than the legacy OEMs. And if you're a full-time employee rather than a contract-based assembly line worker, you have the incentive of stock compensation. That said, I've covered Tesla a few years now, John, and if you speak to current and former assembly line workers, many of them are booked through a third-party management company or work placement company, right? Temporary workers company who take a cut. So the number that they're given on an hourly basis is never as big as they say. It started in the first few weeks of the pandemic and Tesla shut it down pretty quickly in Fremont. It's not really had the traction thereafter. Will it happen now? Hard to say.
Open question. Ed, thank you, mate, for the update. Stock's doing okay, no drama. Tesla up by 0.3% this morning. Let's turn to gaming. Take-Two falling after the release of Grand Theft Auto 6, revealed to be in 2025. Isabel Lee has this one. Hey, Isabel.
Hey, John. So this is all because of a premature leak. So shares were falling around 3.5% during pre-market trading, and it's now pared back some of its losses, but still it's down by 2.5%. So the trailer was originally slated to be published around Tuesday morning at the time of your show, but then it was posted early. And so the company had to move up their timeline and also publish earlier. They posted it on YouTube, and X also suspended account on Twitter, or now X, who posted the game. So Rockstar Games, a subsidiary of Take-Two, published that trailer, and analysts saw the trailer as a positive. But still, the fact that it was being published in 2025 and the fact that there's no there's no set release date is what's causing some disappointment. And why is this closely watched? Because Grand Theft Auto 6 is likely to impact Take-Two's revenue growth. So if you recall, the previous game, which is Grand Theft Auto 5, debuted in 2013, and it was the second best-selling video game in history, and it sold more than 190 million copies. So that's just behind Minecraft's 300 million copies. So this is why this space is closely watched, and investors and gamers are really looking at the game. And now we have shares still lower, though paring back some of its losses, but year to date, the stock is up around 50%, John.
Down about 1% this morning. Isabel, thanks for the update. Let's turn from gaming to streaming and take a look at Netflix. There's a call on the sell side from UBS, reiterating its bullish view on the stock and writing this: management is focused on broadening its offering, deepening connection with fans and diversifying its revenue base, all while continuing to expand margins. The analyst maintaining its buy rating and a $500 price target. That stock is slightly lower this morning, down by 0.5, 0.6%. I want to turn to some deal news. AT&T tapping Ericsson to modernize its US wireless network. Simone Foxman has this one. Hey, Simone.
Hey, John, this is a $14 billion deal. The money is going to be paid out over the course of 5 years, and this is to modernize AT&T's wireless network, especially preparing it for 5G. But it's actually part of a bigger shift called Open Radio Access Network technology. This allows AT&T to really rely on more vendors than just one, than just Ericsson, in parts of its infrastructure. This is a movement that really was catalyzed by the elimination of Huawei infrastructure over time, and so this is what Ericsson calls a strategic shift for AT&T. But what's good news for Ericsson, and we're seeing shares there rally over around about 2% in the ADRs, is bad news for Nokia. Nokia has about a third of AT&T's business. It had really wanted to win this contract, but instead it went to Ericsson, and therefore forced to delay plans to reach double-digit operating margins by up to 2 years. The CEO called this decision disappointing, and one analyst from Danske Bank actually said that this might open up the possibility for Nokia to be disbanded and a U.S. industrial player to come and take part of its business. Ericsson, though, has been slow to embrace this new Open RAN technology, so analysts see this as a good sign, and we're actually watching AT&T shares, which were roughly flat at the open, now move about 3.5% higher off the back of this news.
That's quite a call, Simone. Thanks for that. Nokia down by 5.7%. The broader market at the moment, 8 minutes into the session. If you want the update, we're negative by 0.3% on the S&P, down about 0.1% on the Nasdaq. Very small moves. Let's continue the outlook for 2024. JP Morgan's Jack Manley discussing his outlook for markets, writing this: higher for longer is the narrative unless something breaks in a big way. I still like bonds more than stocks, but either way, quality is important, and a more grounded expectation for the macro backdrop is required if you don't want to get burned in the next 6 months. Jack, I'm pleased to say, joins us right now. Jack, let's take it from the top, and good to catch up with you, mate, as always. Why bonds over stocks?
John, it feels like every morning I wake up and rate cuts have been pulled forward, right? And maybe we've added an additional rate cut at the end of the year for good measure. There is just too much, I guess, pessimism around the state of the U.S. economy, which translates into optimism about the trajectory of Fed policy in 2024. Now, of course, we know rates are going to move lower. It's been one of the only things the Fed has told us from the beginning of this hiking cycle. And so we know that there will be that duration trade that kicks in, particularly in the belly of the curve. But my concern lies mostly on the equity side of the equation. I think stocks have just rallied too much, too quickly. Volatility is almost non-existent. All of it is predicated on this idea that we're going to start to see rates move lower as soon as the first quarter, and they're going to move lower by a whole lot. I just don't see that happening in the absence of an enormous recession. And if we get an enormous recession, that is not good news for stocks. That's my issue right now, John.
So, Jack, given what's priced, do you think we require deep cuts just to validate recent gains?
I think if you're a very short-term investor, John, you probably do. I mean, you're going to have to lean your or hang your hat on this idea that we're getting 100, 125 basis points of cuts next year, starting as early as February or March, in order to justify what's happened to markets over the last, call it, 6 months. But I always approach this conversation from a long-term investor's perspective. And as you know, John, we've spoken about this in the past. I am a stock bull. I am a growth bull. I am a tech bull. And if you are owning growth names right now, you should should be owning them for more than just the next 6 to 12 months. You're looking at 5, 10, 15 years of investment horizon. And if that's the case, this short-term noise, it doesn't really matter a whole lot. But if you're going to be checking your portfolio every single day, I think that's where things are going to start to feel a little bit more painful unless you do see those rate cuts materialize, as is what's currently being priced in.
Can we just elaborate on a little bit of that a little bit more? Jack, the relationship between the bond market and stocks. At the start of the year, my understanding of things was as follows, really simple. If yields go up, tech will struggle, and banks will do well. You can turn that upside down, Jack, because that has not been the story at all this year. Tech has ripped, banks have suffered. If you've got this call on bonds over equities going into next year, what's the relationship between bonds and stocks and the performance you'd expect to see beneath the surface?
Yeah, I'm looking at positive correlations once more, John. I mean, I don't think fixed income is going to do a very good job of providing you a negative correlation to the equity market because the nature of the equity market has just fundamentally changed over the last 15, 20 years. U.S. stocks are growth-focused, they're tech-focused. Those are inherently more interest rate-sensitive instruments, which means that as rates move lower, borrowing costs for these very large, growthy companies decrease, and that net-net is good for long-term earning prospects. So my guess is that correlations are positive, stocks and bonds next year, but both things working in your favor, right? Just the potential for outperformance in bonds relative to stocks, I think, is pretty evident right now, given how much run-up we've already seen in equities so far.
Wei Li of BlackRock was on the program, Jack, in about, I don't know, the last 20 minutes or so. And she said the next year is the time to look away from the United States, look abroad and drop the home bias. Would you take the other side of that?
Yeah, I think this year was the time to do that. I think last year was the time to do that. I think the year before that was the time to do that. You know, I have a hard time justifying a meaningful overweight to international, or call it ex-U.S. equities, because too much attention is being paid to valuations, not enough attention being paid to everything else. Now, what I can do, John, is take a slightly longer-term view to this international story and think about it more in terms of secular trends that are emerging overseas, right? Superior demographics in the emerging world, particularly Asia, looking at India specifically as a place where a whole lot of growth is possible looking forward. Growth of luxury goods, renewable resources benefiting the European equity market. But these are longer-term plays. Short-term, there is just too much headline risk for these regions to justify tactical allocation. So kind of like with that growth bias in the U.S., John, if you're going to take an ex-U.S. allocation in your portfolio, you better be in it to win it for the long run, because short-term, we have seen time and time again, doesn't always play out the way that it's supposed to.
Jack, appreciate the update, buddy. Thank you, sir. Jack Manley, looking ahead to next year. Bonds over equities with a bias towards growth stocks. Just took a look at the DAX. On course to close at a record high today on the equity benchmark in Frankfurt, Germany. Up something like 18% year to date. That one happening quietly, just beneath the surface. 13 minutes into the session, equities look like this, with negative 0.3 on the S&P, the Nasdaq down 0.1. Coming up, Apollo says it's getting harder to beat public markets.
Public markets, they're so correlated and indexed to interest rates and to money flows that if you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening.
That conversation up next.
Public markets, they're so correlated and indexed to interest rates and to money flows that if you actually want alpha, outperformance, you need to step away from public markets. And I think that's happening because we're also revisiting the notion of public being safe and private being risky. This is the framework we used to be in. Private meant venture capital, hedge funds, private equity. Now it just means less liquid.
The brilliant Apollo CEO Mark Rowan weighing in earlier, speaking to markets, political risk and much more in between. Let's recap with Bloomberg, Shonali Basak. Morning, Shonali.
Good morning, John. If you think about what Mark Rowan was saying, this idea that public markets are challenged, that it's certainly true for equities in a lot of ways, particularly because you've seen the IPO market been so dry and companies go public so late and a fewer number of public companies to begin with. But what Rowan is talking about here is not just the equity market. He's also talking about risks to the public fixed income market. Now, Now, this is a risk that a lot of people have brought up, including Citadel's Ken Griffin. The more that activity moves to private markets, people trading the idea of liquidity for more yield in private markets, Rowan is arguing does not need to be a risky endeavor in and of itself. Now, what this really is also, John, is a shot across the bow to the banking system. You've had Mark Rowan himself really speak over months now about this idea that every dollar that moves out of the banking system reduces systemic risks. Remember, Apollo's money is not like a bank where we've seen deposit flight throughout the year from big regional banks. We've also seen Apollo instead take money from insurance companies, increasingly through high net worth channels and through fundraising from the likes of pensions and sovereign wealth funds. Now, is this a safer model? We are seeing the likes of Apollo and its rivals step up to partner with the banking system to provide more capital to the system. But really, whether this is less of a systemic risk is in the mind of regulators, certainly in the United States and around the world.
This is still really early days, Shonali. Do you see the banks and these asset managers working against each other or ultimately together?
So Apollo has this saying that they're not dancing in the streets in the wake of more bank regulation. They're dancing with the banks in response to what Jamie Dimon had said a couple months ago about the private equity folks really feeling the love out of more pain on the banks in terms of regulation. Remember, the bank CEOs take to Congress tomorrow. They're addressing the Senate on risks just like this. And I bet you they're going to be fighting back hard, John, against those new regulations. And they're going to be pointing to the Apollos of the world and saying, listen, that's where the money is moving now.
The financial landscape is changing quickly. Shonali, thank you for the update. Really enjoyed this morning with the team over at Apollo. About 20 minutes into the session, we are negative by 0.3% on the S&P 500. Tons of data out there. Mike McKee has some for you. Hey, Mike.
Good morning, John. Well, we've got sort of the opening act for data today. Coming up at 10, we have the ISM Services Index. Before that, the S&P Global Services Index, and it comes in matching what the preliminary number was, 50.8, but that is up from the October number, so it's an improvement in services that we're seeing from the S&P numbers. Their composite comes in the same as it was in the preliminary and in October, 50.7. Around the world, though, it's kind of interesting. We saw France, Germany, and the Eurozone still all negative in terms of services, suggesting contraction in those economies now, and there is much more talk of the ECB perhaps cutting rates sooner than the Fed. The one country to pat on the back, John, is yours.
There we go. Look at that.
It's supposed to be the sick man of Europe, or the European area, since they're not in Europe anymore, technically. And instead, they're seeing growth in services and the composite.
We're in Europe, Mike, just not in the European Union. That's the important piece of this. Mike, I want your thought on this quote here from Mohammed Al-Erin on Fed Speak. I do believe the Fed is done raising rates, but I don't think that validates what is in the markets about rate cuts next year. They still have a significant communication problem, and they still have a credibility problem. What would you say to that?
I think they have a slight communication problem because, remember, the markets are all over the place on every given day. But Jay Powell, when he spoke last Friday, said that the Fed basically was done. They were in extremely restrictive territory, but then he went on to say, we are not going to be cutting rates anytime soon. Didn't come out as strong as he had, so people took that and ran with it. But maybe they'd stop saying both things and just say, we're not cutting rates, we're leaving them where they are.
Selective hearing in the bond market, Mike. You and I have been talking about that over the last week or maybe the last decade or so. Mike McKee there. Let's get you some sector price action, how this session is developing. We're down by about 0.3% on the S&P. Abby has more.
Hey, John. Well, if the loss holds, it could be the first back-to-back decline for the S&P 500 going toward the end of October. It's a broad-based decline, even though it's on the smaller side. The two sectors up at this point, tech and communication services. To the downside, the rest of the universe, we have a number of sectors that are down more than 0.5%. The worst sector, materials, down 1.5%, the worst day since October. I should say the worst 2 days since October. Let's dig in just a little bit more, because something that makes this sector interesting on the day, John, you can really see that cliff dive down. All 29 members of the material sector are declining. It's not really clear what's behind it, but you could take this as a broader read on demand in the economy, and maybe it's slowing.
Abby, thank you. Up next on this programme, we'll take another sneak peek of the calendar for the rest of this week in the trading diary, and I'll bring you the latest estimates in our payroll survey. Payrolls a few days away from New York City. This is Bloomberg. 25 minutes into the session, 2 days of losses for the week, so far at least, early days. We'll see if this sticks. We're down 0.2% on the S&P. That's the price action. Here's the trading diary. The calendar stacking up as follows for the rest of this week. At the top of the hour, ISM services and JOLTS data coming up. On to Wednesday, US bank CEOs testifying before the Senate, plus the fourth GOP presidential debate. Thursday, got another round of jobless claims for you. And let's just sit on Friday. The payrolls report just around the corner. The estimate drifting a little bit higher as more estimates come in. The median estimate at the moment, 189. The previous read, 150. Unemployment, 3.9%. Wages, average hourly earnings, month over month, 0.3% is the estimate. The previous month, 0.2. This can change over the next couple of days as we get more estimates in our survey, but that's the latest median estimate for you across the board. More still to come this week from New York City, though, for me this morning. That does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.